Realty Income Corp has just bought in a stake in the Bellagio in Las Vegas. In this video, we're going to go through this transaction that they made. We're also just going to look at Realty Income's business a bit at a high level as well and give my thoughts on the company. If you like this kind of content, be sure to give this video a big thumbs up. And if you haven't yet, be sure to subscribe to the channel. But we're just going to jump right into this one. So as you can see on the screen, Realty Income just invested about $1 billion into the Bellagio, Las Vegas, which is obviously one of the prize jewels of the Las Vegas Strip and entertainment and gaming real estate in the world. Looking at Realty Income stock here, in the last week since they announced this acquisition, they really have not moved at all. The stock is trading at essentially the exact same price, so the market's doesn't really care too much about this in either direction. The market cap of the whole company is about $40 billion. So this only represents a couple percent of the company here. If you look at the dividend yield of Realty Income, I believe they are currently paying out about a 5 to 5.5% dividend yield, closer to 5.5, I believe. And they're expected to do about $4 of funds from operations. So they're currently trading at right about 14 times funds from operation in terms of valuation levels here. The company's had a hard time in the last year, down 17% as interest rates gone up. There's other sentiments around REITs and real estate and some recorrections in terms of how they're being valued. But Realty Income really is one of the best REITs, triple net leases, really strong tenants, which we'll get into. And this acquisition just shows how they're still kind of on the offensive with their capital allocation strategy, how they're trying to drive scale and synergies across their portfolio, and they're really breaking into new real estate mediums as well. So here's some property highlights of the Bellagio in Las Vegas. You have huge casino, obviously, just tons of acreage and square footage. In addition to just a gaming facility here, these casinos are like mini cities. So it's a casino, it's a hotel, they have a ton of high-end retail, they have lots of restaurants, they have lots of open space. And these agreements are really lucrative just because essentially Realty Income does nothing every month. They don't do any repairs. They don't really manage any day-to-day business. Everything is operated by, I believe, MGM, who owns the Bellagio's business. And then they just pay a triple net lease check to Realty Income, which will flow into the dividend that gets paid out on a monthly basis. So really big scale, really big investment, but really easy one to manage here over the medium to long term. Thesis here, they thought that this was a favorable risk-adjusted return because these kinds of REITs or these types of arrangements also have rent escalators. So they increase every year behind, usually it's inflation or a minimum of 2 or 3%, whatever one is higher. So they're saying here Bellagio has a triple net lease for 26 more years, so decades into the future, and they have escalators in terms of every year they have to pay a tiny bit more, a tiny bit more. So if you have the same cost of capital and you're just getting rent accelerations every year, your margin and your NOI for the property is going to grow over time. Another interesting aspect here is they inherited the 3.67% interest rate. That's good for another 6 years. That significantly increases the spread and probably made them invest even more money to buy the asset since they were buying that cheap debt for 6 years as well. That all goes into the calculation of what the net present value of the asset is worth with that cheaper debt. Another element is MGM is a really strong operator, great business owner, and as long as they are operating their business well, continuing to be highly profitable, they really don't have to worry about getting their rent payments on a monthly basis. This company owns a ton of different gaming assets around the world. So even if this one asset lags a bit, hopefully their overall business is doing well enough for them to honor their agreements. And the thing I like about like gaming real estate is it's really hard for these businesses to perform without the real estate. It's not like it's a company that is serving customers online in addition to in their stores. If they don't have the real estate, they don't have a business. So that really puts the landlord in a really strong position to get their rent on a monthly basis. And Vici Properties, who owns lots of the assets on the strip, has mentioned how since they went public about 2017, so 5 or 6 years ago, they've collected 100% of rent every single month, even through the pandemic when these companies were in extremely tough situations, because they really have a really strong position in the relationship with these tenants, given that they kind of hold the keys to their entire operations. And as we look at, Realty Income continuing to make these big acquisitions, this was just $1 billion for about 22% of the Bellagio. Should have let off with that. So they valued the total Bellagio at $5 billion. They're really looking to make bigger and bigger investments. So this really opens the door to potentially buy another 20, another 30, maybe another 70% of the Bellagio to take it all out one day, because they're really looking at allocating more and more capital out into the markets, because they believe that the bigger the company gets, the better opportunities that are going to be out there to bid on huge sums of real estate collectively. And there's just not going to be too many other potential suitors that can throw out $1 billion, throw out $5 billion at one time. And they really want to get to that scale that they're almost able to acquire real estate at wholesale prices, which is what they kind of throw out here. Because if you have one trophy asset that's a shopping mall for $50 million, $100 million, there's dozens and dozens of REITs that are able to bid on that and bid that price up. But if it's a portfolio that is $3 billion of properties, that makes it a lot less able for that many REITs and that many players to be involved. Usually it's just 2, 3, 4 big guys. So they really want to be one of those standout REITs that get invited to the table with a couple other people on these deals, so they can start hopefully getting wider spreads between interest rates and cap rates, and maximize shareholder value through size and scale, which is essentially what they get on at their earnings call. And I think they're trying to highlight here as well. It's also interesting here. I just saw this for the first time now. You can see rent increase terms goes up 1.75% in year 1 to 10, and then year 11 to 30 goes up 1.75%, or CPI, which is capped at 2.5%. So they have about 2 to 2.5% rent escalators every single year, compounded over the next 26 years of this agreement. Looking at Realty Income's other business, so gaming is was only 2.7% behind the Wynn Encore that they own in Boston. This is going to almost double it, probably to closer to 4% of their business in terms of annualized rent here. So it's going to go up a bit, but for the most part, this is a retail company in terms of the assets and the triple net leases they own. You can see their tenants here on the left-hand side, really strong tenants for the most part. Don't have to read them all out. You got Dollar General, 7-Eleven, FedEx, LA Fitness, BJ's, CVS, Walmart, Tesco, etc. And this is for their whole company. The other thing that I like showing is just how geographically diverse this company is. You can see some of their top geographies, but when we go into their overall portfolio here, you can actually see they're in every single state, even if it's just a few properties. Obviously, the big ones like California, they're at 6%, Florida here at 5%. Up here in New York and stuff like that, Texas is 10%. But they have properties in every single state, so really diverse across the U.S. And then they also are building out their European business here, most notably in the UK, but they recently added Spain and Italy. So if we look at what their portfolio looks like out there, you can kind of see here in terms of half of their European business being grocery, obviously not as diversified as their US business, but they're really looking at growing this business year over year in terms of having a bigger European business. And then the last thing I just wanted to show here, you can kind of see, and we were looking at this a bit earlier, but from an industry standpoint, convenience stores, grocery, dollar stores, home improvement, drugstores, QSR restaurants, all of these areas are really defensive for the most part. You know, you have some that are a bit more cyclical. You have general merchandise down there at 4%, health and fitness maybe, depending on what goes on, home improvement to some degree. But for the most part, they should be able to weather any recession or storms given their diversified mix of tenants and types of assets. Here you should see just how diversified their properties are into, or how heavily retail their properties are. You can see here that 82% of their properties are retail. So huge chunk of this business. This is a retail company. So if you're not comfortable owning retail stores, owning shopping stores, I wouldn't buy this stock just because they own 1/5 of the Bellagio or Wynn Encore. It's such a small piece of the pie. So make sure that you're thinking of this as a retail stock, and then these are just some diversifiers that are in there to maybe weather any short-term storms in retail. But at the end of the day, you're buying a retail company here. So I thought this was an interesting buy, one that I wasn't fully expecting. I assumed a company like Vici would end up picking this one up, but it seems like Realty Income came in here and outbid them. As a Realty Income shareholder, I did like this buy. I think it's great to diversify into gaming a bit more. It seems like the long-term leases paired with the rent escalations and the hands-off nature of these operators in terms of not really needing to do much capex work to keep these buildings and these assets up to snuff. Lots of those are just on the operator, and they prefer to manage things themselves as well. Just makes them great long-term investments. And I like having some exposure to the gaming side, so I don't have to separately invest in Vici or have fear of missing out in Vici stock. So I like that they made this buy. They added it to their portfolio. Would love for them to own 50%, 100% of Bellagio down the line as they spit out more free cash flow and continue to drive scale and size of their portfolio. So this is one that I'm currently down on my Realty Income position, but I think that it's in a spot with lots of other REITs that will eventually go up with time. And it's just a bit depressed now with interest rates being as high as they are, recession fears and whatnot. So I think it's a good time for me to build out my Realty Income position a bit bigger even, and hopefully we'll come out a lot higher on the other sides of things. And in the meantime, I'll take my 5.5% dividend to the bank. So if you like this kind of content, be sure to let me know by giving me a thumbs up or writing a comment below. And let me know your thoughts on Realty Income and this acquisition of Bellagio. Have you ever been to the Bellagio? Let me know in the comments. We'd love to hear from you guys. Thanks for watching, and I'll see you guys in the next one.